Hey everybody, my name is Kyle Knott and I am not your average finance guy. Today we're going to go over a little scenario about real estate investors and how they go in the traditional way that most people go through and buy real estate. Okay, this is how I started when I first got into it. I saved up a bunch of money and able to get down payment for my first property. Bought that, used all that cash flow to try to buy more. So the typical way that we do this is we've got income of however it is. Mine was through my job, years and years and years. That would go into my checking account at the big bank, and my income would come in, and slowly throughout the month, all my expenses would drain that down, suck that down. Hopefully, there's a little bit left over at the end of that paycheck, and you put that over into your savings side. Okay, savings or investment side of the bank. And hopefully that goes up, 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 up until finally one day you have enough for a down payment on this cute little house. So once you get that down payment for the house, you get your goal, that's done. And then you take all that, boom, you knock it out and you buy this house. Hopefully this house is cash flowing, whatever kind of investment it is. Hopefully it's kicking off some extra cash flow, and you're able to take that extra cash flow and then you're able to put it back in here now. So now what you've got is you got your income either from your rent or your job or whatever it is. You got your income coming in. You're still kicking more money over to savings. Plus you've got your extra rent, your extra cash flow from your investment now kicking that savings up. You build it, we build it for hopefully now it's faster because we got some more income coming into it. Now once we get to that goal, then we can go and, we can buy another cute little house. And then that's going to kick more cash flow back in, and then it grows faster. And then by the time we get another one, you understand at this point, right? We can just keep on getting, my houses are pretty bad, but keep multiplying house. And there's nothing wrong with this strategy, but what's the savings account paying you? The savings account's paying you 0.5%. That's the average right now. So basically nothing, right? What if instead of doing it this way, you did something just a little bit different? I heard the analogy the other day. It's kind of like rewards credit card. If you're going to buy something for $10,000, you can either hand them $10,000 of cash, or you can put it on the credit card. It's still $5,000 to you either way. Granted, they're eating some fees, but you're going to get all those rewards, whether it's travel rewards or cash back. So why not put it on your credit card first? And then when you get the credit card bill in a month, then you can pay your cash and put on the credit card, knock it out. Now you've got rewards, right? So it's kind of like that. So this next concept, you're really doing nothing different, but you're getting rewards. So let's take a look at that. I'm with growing at 6.6%. I'm fucking this all up. Family bank. Okay. So with real estate investing, I don't know why anybody wouldn't do this. To me, it's a no-brainer. I've been doing this for about 8 years now, and it's amazing how much I watch my cash value just keeps growing, and it's compounding at right now currently 6.6% interest. That's because it's a dividend paying policy. It's guaranteed. I'd have to go back and look, but I think it's like 3% that's guaranteed to pay. So guaranteed 3%, or what's this? I mean, in the past, I guess I had a 5% once, like back in 07. But since then, it's been basically 0.0 nothing, right? So this is a big deal right here, because this 6.6% is where your cash value always stands. Over here, when you take this chunk of money and you buy your cute little house, you are now making 0.5% on nothing because you just took it all out. When you take the same amount, if you got cash value, what you're doing here is you're taking a loan from the insurance company themselves. So the insurance company gives you a loan for this house, and then you take the cash flow from this house and you pay the insurance company back until you've taken care of down payment or whatever. If you want to pay for the whole thing, go for it. You wouldn't need a mortgage, but I usually get a mortgage. I just use this for my down payments. So your down payment, then once that's paid back, that's all completely separate. You never took money out of your cash value. So this is always growing at 6.6%. So it's almost like your money's working two places at once, which is, to me, it's the cool thing. So, all right, let's say I take a loan from the insurance company. they know you've got so much cash value. It's like, all right, we'll give you a loan up to, a little bit less than that to make sure they're good. And they'll give you a loan for the down payment. You pay them back. Say it takes, I don't know, a couple of years to pay that back. So in a couple of years, where maybe it's 1 year, the cash flow no longer goes back to the insurance company. Now that can go back to your checking. It can go to your bank. It can go to whatever you want to do. You can try to, you can put it back into the cash value, and you can up this as you go along. We've got a lot of options here. So, and that's ideally what it does is then we start taking our cash value and we start cranking, we take our cash flow and we start cranking this cash value up. So now, maybe in a couple of years, your cash value, yes, you're putting money into it and it's growing. So now we've got this much cash value. So, at that point, maybe you can go ahead and we can buy a duplex. All right. So now we got 2 front doors here. So we went from a single family, now we're at a duplex, and we got some more cash flow. Same thing. We get the loan comes from the mutual company, okay, for the down payment, and then we take the cash flow from this and this. Let's knock that down as fast as we can. Let's pay that back. Let's pay that off. Once that's paid off, wipe that out. Boom, bring this up. The beauty of this, as this grows, it's still going at 6.6% interest. That compounding curve that hopefully we've all seen, know, and love, that starts day one. So the earlier you can start this process, the better off you're going to be. Trust me, please get a hold of me and we can run some illustrations, and you will just be amazed at what is going to be available in 10, 20 years. Okay. So this does take a little bit to get off the ground. Your first year, if say you've got $50,000 here, and you have 50,000, you move that 50,000 straight cash value, you will not be able to use all 50,000 of it. It might be 40, 45, but usually within 4 to 5 years, say you put $10,000 a year in for easy numbers. In 5 years, that's $50,000 that you've put in. Usually in the 5th year, you'll be able to take out more than you've put in. So if you do nothing for 5 years, you've got 50,000 in, you should be able to pull out maybe 55. So, and from there, it just keeps getting higher and higher and higher. So, as you pay this year by year, it keeps going on. Towards the end, you just really don't even have to pay it anymore because the cash value is growing by so much every year that you just go ahead and take a policy loan and make the premium payments, and the whole thing just keeps, it literally is a snowball running down a mountain on this. So, I hope I'm trying to explain this the best I can. I know it took me forever to get it figured out, but once it finally did, it clicked and I put it into place, and that's how I learned. I just do it. And this has been probably the best financial decision outside of first buying my rental properties. Is probably the best financial decision I made. This is being a very close second by keeping this whole process moving. So please let me know if you got any questions. Hit me up on my website, my email there, and hope to explain this better. I know I'm probably confusing the hell out of you, and I'm sorry, but I'm doing my best, and I will continue to make some videos, try to get the word out on this. All right, thanks everybody. Good luck, and happy investing.